Hey everyone, welcome to the Hampton Roads Real Estate Network. I'm Ryan Ponseti with eXp Realty, and it's time for the monthly market update. I'm going to go ahead and take you through the most recent changes in sales price, home inventory, mortgage rates, and all the important stuff over the past month or so, bringing you up to speed to the current date in all the relevant news of the housing market, specifically in the Hampton Roads area, but of course, national news as well. And spoiler alert, I've got a lot of good news to bring you, which is always exciting. There's a lot of positive changes in sales price, mortgage rates, home inventory. So things that we've been waiting for quite some time are actually looking like they're coming to be, maybe a little bit later in the year than we liked. But anyways, they're here, and we're going to go ahead and take a look at what those changes are and how they might impact the near future coming up towards the end of the year. So let's go ahead and jump right into it. As always, we start with a snapshot of my local market here in Hampton Roads. We always start with the top line, which is the median sales price. This is good news. We are seeing a downtrend in the month of July for median sales price coming off that 350 mark. We had been hitting new record highs for the past several months. Of course, it's still up year over year, about 4%, but seeing that curve downward is nice to see a little bit of pressure off that total sales price. We do like seeing that. So settled sales, that's pretty much flat. That hasn't changed much. So there's nothing really to discuss there. Median days of market, same thing. It's been hovering in this range for quite some time. 17 days is still fast overall, but it's slowing down a little bit, which you kind of expect towards this part of the year as we see summer ending and things start to naturally slow down. Average percent of list price, we always touch on this as well. Not a lot of change there. Sellers are still expecting to get about what they list their home for is the takeaway from that. And we've been around 100% for a long time. The most exciting part of this snapshot is the last three items: the new listings, active inventory, and monthly supply of inventory. So these are all up significantly from this time last year. And they are also up month over month as well. You got over 10% in new listings from this time last year, over 30% in active inventory, and up 25% from month supply of inventory. So these are all good things. We want more homes in the market. We've been waiting for that for a long time. So it's really good to see things are going in the right direction. It does mean that some homes are sitting around longer, of course, because the interest rates are high, but that is changing. So we're going to take a look over the next few slides. We're going to take a hard look at mortgage rates and what that might mean for all of these indicators. And we're going to really focus on that this monthly report, because that's where we're really going to see most of the changes, I think, towards the end of this year. And it's going to affect a lot of what we see this upcoming year and the beginning of next year. So let's go ahead and jump right into that. We'll start with mortgage rates have dropped over the last month. Starting in July 15th, that box in the top left corner, they were right around 7%. Okay. So that was just a month ago. They were at or a little bit above 7% for your 30-year fixed mortgage. As of August 7th, they had dropped to 6.6%. So a very steady downward trend into the early parts of August. And then now our 30-year fixed rate mortgage national average, of course, is 6.5%. So 0.5% or more difference between this time last month. So that is really good to see. Buyers have been waiting for this most of this year. I know if you've been watching the monthly market update that I've been doing over the past 6 months or so, we've been waiting for this to happen. Basically, we've been waiting for rates to come down to kind of help ease that affordability issue that we've been facing with the high sales prices. So this is a good thing, right? This is an article from Yahoo Finance. In 2023, the 30-year fixed rate mortgage hit nearly 8%, and it slammed the brakes on the housing market. Now, the 30-year fixed rate hovers around 6.5% and will likely trend down in the coming months as inflation continues to slow. Lower rates are good news for potential buyers and sellers alike. So that right there kind of affirms your initial gut feeling that this is a good thing. It's going to help buyers. It's going to bring more buyers out, which helps sellers because you have more people looking to buy their homes. Okay. It continues though. Still, housing affordability continues to be a dilemma. Buyers are dealing with more than just high interest rates. They are facing record high home prices and low supply. In the second quarter, affordability deteriorated as mortgage rates remained elevated. Okay. So affordability is still an issue. Now here's where things get a little bit interesting in this next part. It says, despite this week's uptick, and that's just referring to most recently, early this week, it went up like 0.02%, very small increase. The recent downward trend in rates has spurred some activity in the market. Applications to purchase a home increased 3% from the previous week, but still are 8% lower than the same week a year ago. So let's stop and think for a second. They're 8% lower than they were in 2023, which had interest rates around 8%. So that made me pause a little bit and think like, okay, so they've gone down pretty significantly over the last month, but people aren't necessarily beating down the doors with loan applications, right? So it continues to go on. Meanwhile, homeowners are capitalizing on the opportunity to restructure their existing loans. Applications to refinance a home loan surged 35% in the previous week and were 118% higher than this same week a year ago, which of course that 118% makes total sense. Nobody was refinancing last year, right? But the part that I highlighted, 35% from the previous week. So people are beating down the doors to refinance their home. Okay. So this makes me a low key concerned about home inventory in the near future. So if you've paid attention to my market updates in the past, I've talked quite a bit about rate lock. Okay. Just short recap. Someone has a low interest rate on their home. It kind of locks them into that home. Even if they move out of the home, they will keep it for a rental because they have a 3 or 4% interest rate. So that locks up the inventory. Okay. People aren't moving as readily as they were maybe before. So with this new interest rate drop, and if it continues to drop, you'll see more and more people refinancing into lower rates. And then, as we know, mortgage rates ebb and flow. And if they go back up, we could see another wave of rate locked homes, which does not help home inventory. Okay. So that's something that we want to keep an eye on. And the main question is, are rates going to continue to drop? So we'll go ahead and take a look at another article by Bankrate. I'll just read a couple of highlights here for you. It says the economy drives whether mortgage rates go up or down. As witnessed by the recent stock market sell-off, 30-year mortgage rates tend to fall in recessions and economic downturns. And that's going to be important to keep in mind. Okay. It continues to say the Federal Reserve has a dual mandate to keep inflation and unemployment low. With high inflation and Fed raises its fund rate, but if it's held too long or too high, it can slow the economy down, leading to unemployment. With our eye on recent economic data, many forecasters expect the Fed to begin cutting rates in September. So it goes on to say that they expect rates will drift lower through the remainder of the year, and that the Fed's getting closer to their target rate of 2% rate of inflation, which makes them feel bullish on more interest rates being cut in September, maybe even into the winter months, November and December. All right. The last little part there just says that bond traders have been expecting that the Fed cut rates next month. So bonds are important because the Fed doesn't actually cut mortgage rates. They turn the dials of the economy through other means, and mortgage rates often respond to 10-year treasury bond rates. Okay. And so that's important because keep in mind what that one line said about 30-year mortgages tend to fall in recessions and economic downturns. There's not a consensus on all these factors here. So this other article by Mortgage News Daily, as you can see by the titles, just goes out and says there's zero evidence of a recession in the data, and bonds not happy, meaning bond investors, I assume. And the jobless claims are actually better than they were expecting. So in that one highlighted box on the left, it says jobless claims coming in at 227,000 versus 235,000. Okay. So the jobless claims are a little bit better than anticipated. So that's a good economic indicator. And then the right box, nothing dramatic happening in the labor market equals no case for a rate cut. Okay. So the big takeaway from these two articles is that the economy, or at least the indicators for the economy, are good. So that doesn't fall in line with a scenario where interest rates go down when there's a recession or market downturn, right? So the question is, where are mortgage rates going to go? And of course, I don't have the answer to that. Maybe nobody really does. I think the big takeaway is that mortgage rates could continue to go down. And if you're waiting for that, then that could be good news, but they could stay about where they're at now, 6.5%, which would still be better, but they might not continue to fall the way or at the rate that you want or would hope. So in summary, what does all of this information mean? Well, let's think about the positive things, right? Inventory is increased. That's a good thing. Sales price, that's fallen. That's a good thing. Mortgage rates have fallen. That's also a good thing. So these are three things that we've been waiting for, and they are good things, particularly for buyers, even for sellers in a certain sense, right? But you might want to pump the brakes a little bit because refinancing activity is actually greater than new buyer activity. Now, maybe we just haven't seen those new buyers come in yet because affordability is still a concern for most potential buyers, and they could very well be waiting for lower rates. And maybe there's more buyers waiting around to see if the rates continue to drop. And many analysts are bullish on the fact that rates may drop in the future. So if you're waiting for that, if you're one of those people waiting, then, you might get your wish. But there is uncertainty about this. We don't know for sure that that's going to happen. Just like at the beginning of this year, if you were tuning in, we were anticipating rate drops early in the year, and they just never came about because there's a lot of factors that go into that, right? So the last point is if rates continue to drop, it could worsen the inventory issue over time. That's that rate lock effect that I was talking about. And for me as a real estate agent, it's hard to see a situation where sales prices continue to fall if inventory doesn't get better. So if there's low inventory, there's still going to be upward pressure on sales price. So maybe they stick around to the levels that they're at. Maybe they increase. And in the scenario where you do see rates fall even farther, and then you get a surge of buyers, that would obviously naturally lower the inventory levels as well. You could put more upward pressure on the sales price. So we're kind of in this weird situation where it's good news, but there's caveats to it. So what is the conclusion? What's the main takeaway from this month's market update? It's kind of the same as it always is. Don't time the market. If this is the right time for your family to buy a home, you want to start taking the steps to pursue it. Okay. Timing the market is generally never good advice, no matter what market you're talking about. And if you're in that camp where you're trying to wait, now, of course you have to wait. If you can't afford it, or you can't afford something that works for you, then you have to wait. You have to cross your fingers and hopefully the rates get better and the sales price continues to go down. But if you can buy what you want and you're just waiting for rates to drop just because you don't want to miss the boat, so to speak, or you don't want to pull the trigger at the wrong time, that's something that you might really want to reconsider because you don't know what the market conditions are going to bring when things do change. Okay. Right now, things are fairly favorable for buyers and sellers are giving more concessions. They're repairing more things in my experience with the past deals that I've had this year. So there are advantages to the market as it is right. But at the end of the day, you have to decide for yourself if the time is right for you and your family to do that. So the best way to do that is to like and subscribe to this channel and stay up to date and stay informed. Reach out to me if you have any questions. Partner with a trusted real estate agent to help you navigate the current market conditions when you're trying to buy. And then good luck. So that's all for me, and I'll see you out there.